right, welcome everybody. Thanks for coming back for another session of our podcast. And we talk a lot about different strategies. We talk a lot about different asset classes. What we have mentioned several times, and one of my core focuses is how we rotate from one asset class or one sector to the next or one group to the next. And with me today, very special guest. And I told her this off camera, I think a few weeks ago. I was a little bit starstruck when we first spoke because I've been watching her on TV and other places for a long period of time. Katie Stockton, she is the founder of Fairlead Strategies and the portfolio manager of the TACK ETF. That's TACK. Katie, how are you?
I'm great. Good to see you.
It's good to see you too. And one of the things that I think when we first started talking that really was interesting to me is, and I've been familiar with you guys' research for some time, as I said, is when you started taking that research and essentially folding it into an ETF, which is really focused around rotation. And so I was just kind of wondering if you might be able to give our viewers a little bit of your definition of that rotation. I know you and I both have a technical background, um, and so if you could give us a little bit of uh, again your sort of idea of because everyone's got a bit of a different definition.
Yeah, for sure. And as you mentioned, I'm a technician and really solely that, right? It's my sole expertise, but it really lends itself very, very well to any kind of sector rotation analysis or strategy, in that these are not just price-based tools that we're using, but also relative strength, right? Relative strength is a big part of our process as it pertains to that sector rotation. So we look at relative strength two ways. We look at it as ratios. So we'll take something like the technology sector benchmark that we're using against the S&P 500, and we'll look at that as a ratio, and then we'll actually apply technical indicators, sort of the traditional momentum based tools or overbought oversold metrics, and analyze that ratio using those same metrics that we'll use on the price trends. Then we also use something called a relative rotation graph, commonly known as an RRG. And that's a great way to understand the rotations in the market at any given time. And we usually say, when we're saying market, the US equity market, but you can apply it to any market. So really any asset classes have the ability to be sort of pulled apart from a rotational perspective. So it's a great discipline, lends itself very well to sector rotation. We've always focused on it in our research. We publish research on a daily basis and have about 9 reports that we put out to subscribers per week, of which at least 2 of them are focused on sectors. And we picture those sectors both in absolute and relative terms versus the equity market more broadly. And we have takeaways that we make sure to sort of isolate based on the time frame that we're paying attention to. So in our research, we focus a little bit more intermediate terms. So what does maybe the next quarter look like in relative strength terms? But in our ETF TAC, we are a bit more long-term in focus in terms of our sector rotation. So we're actually using month-end closing price data for our analysis there. And that's with intention because we're trying to, I'd say, minimize noise and capture major inflection points on the sector front.
Makes a lot of sense. In fact, when I talk to clients, and this was, I think you two have an institutional background, but certainly when I used to, be on, JP Morgan is my alma mater, it was never a matter of talking about very, very quick moves like intraday, or even like less than like a week or so, at least where I was working. And so when I came into the world of more sort of the hedge fund oriented kind of folks, and then of course retail investors, it very quickly turned into lots of people having, at least in addition to the longer term timeframes, shorter term ones. So I guess the question that I have for you, because I see this is one of the things that people struggled by far the most. How do you know what time frame to focus on? How do you keep them separate? Because you could have rotation intraday, right? And you do have rotation intraday,
You
and
do.
then
It's
you have
almost
it.
fractal, right?
Yes,
Any time
exactly.
frame can have its own trend, and that is sort of the hard part. I'll say, in terms of our research, we focus on multiple time frames. So we usually start very long term, looking at the monthly bar charts, And then we'll kind of zoom in progressively to the weekly bar charts. That's more of an intermediate term takeaway. And then to the daily bar charts for our short term takeaway. And if we had to define those time horizons, the longer term would be, months, maybe 6 to 12 months on average. The intermediate term would be about that sort of 3-month time horizon, the next quarter or so. And then the short term, of course, will be days to weeks. So we can be ultra short term. We can look at intraday charts, 60-minute bar charts, and have what we feel are pretty reliable takeaways in terms of what important levels there are, what does the momentum look like, if something's broken out or broken down. So technical analysis, I would say, does lend itself very well over any time frame that has some liquidity to it.
Now, in terms of your definition before, which I thought was brilliant, because you came right out of the gate talking about relative, right? At least the way I look at it, the way I've been taught, the way we use it in our work, it's really all about relative. And I think a lot of investors, particularly as they start, becoming more familiar with markets, not necessarily professionals, where that's the relative analysis is a big thing, but I think people are focusing much more on the absolute chart. So you look at your S&P chart in absolute terms, but really what we're talking about here, rotation, is all about relative. I was wondering if you could go just a little bit deeper on that. So let's say you see a sector that's starting to look better in relative terms versus another one, or versus the broader market. How do you kind of step yourself into that? I know you zoom out, right?
Yeah,
But then what?
it's really important. And this year, I'd say sort of more than ever, in that we've had very concentrated leadership. And leadership is different than breadth. Breadth is market participation. How many stocks are up on up days, or how many sectors are participating in an uptrend or a downtrend. That's breadth. Leadership is, where is the relative performance coming from? This year, 2024, has been concentrated leadership in the mega cap complex. So we know it's, the Apples and Microsofts and Nvidias especially of the world that have really driven the uptrend this year. And that means also that the mega cap heavy sectors have driven the uptrend, right? So that ends up being technology, communication services, and consumer discretionary. You can guess what stocks that we're referencing there, Amazon, Tesla, so they're all packaged in these sectors, which are cap weighted sectors, at least as TACK invests in them. So we have to be really mindful of where that concentrated leadership has been. And we have owned these sectors, of course, in the TACK ETF to take advantage of their relative performance. The way we approach it, and there's obviously multiple ways you can approach it, but the way we feel is additive over the long term is to actually equal weight the sectors. So we take the 11 sector SPDR ETFs, and we're evaluating them for long-term momentum characteristics, making sure they essentially don't have any big sell signals from an overbought, oversold perspective. And then we're sort of weighting them in our work, not weighting for the portfolio, but we're in a way ranking them from a relative perspective. And all of that taken together becomes the foundation for our portfolio, which we max out at 8 sector ETFs. So we're basically taking the bottom 3 and kicking them out. We're with that have about a 12.5% position in any given sector SPDR ETF in like a full bull market cycle type of portfolio. Whereas if we don't have that full bull market cycle, we will be able to move their buckets, that 12.5% that would be normally or hopefully designated for a sector in a strong tape. Well, we'll take that bucket and we'll actually give it to a different asset class. So we will put in that bucket short-term treasuries, sort of our cash equivalent, long-term treasuries, and gold, all via ETFs. And we do that just to manage risk through big corrections and even more importantly, the big down cycles like in 2022.
And I was fortunate enough to read your research for a while. The focus on the ETF is really largely in the sectors, right? So you literally look at S&P centric strategy essentially and rotate within those.
That's right. So we are, holding what we feel are the best 8 sectors based on our methodology. And the methodology consists of just that: the momentum, the overbought, oversold metrics, the relative strength, all of that you see in our research on a day to day basis. That's the stuff of the model that is driving TAC, and that's what creates the sector rotation in really a systematic fashion. We believe in systematic long-term investing, sort of like an informed and dynamic buy and hold strategy, where the old buy and hold, I think people have sort of smartened up to the fact that you don't need to ride the market down through major down cycles, right? You're well served to reduce exposure in that type of environment. And yet, both in those down cycles and, of course, during proper bull market cycles, you can, I'd say, best leverage the market through that sector rotation. It's almost like low hanging fruit from the market, because the dispersions on the sector front any given year, you can look at it year over year over year and see that the dispersion between the best performing sector and the worst performing sector will be 50% at times. So it's a really wide dispersion. And because they're somewhat accessible, these products, right, these sector ETFs that we can use as the stuff of our portfolio, it's really a great strategy. And to have an ETF wrapper around it, it creates that tax advantage versus perhaps doing it yourself, right, and trading the individual sector ETFs and trading in and out and incurring taxable implications with that, or perhaps going for a mutual fund that will have the distributions year over year.
And I think in general, people kind of underestimate, how, I'm going to say, difficult this actually can be, depending on what the news cycle looks like. But just quickly going back to the time frame question. So you were established that this rotation happens in all time frames. In the ETF, you're looking at a little bit of a more longer term. What would you say? Because it's just one of the questions that we always get, and it's one of the first points of education I try to get out of the way. But just from your perspective, let's maybe talk about the ETF time frame. What have you found? And I'm sure it varies, but some sort of an average. How long do you typically remain in a sector? Obviously, I know it's a difficult question to answer, but I know people always have a hard time. Is it 5 weeks? Is it like it confuses people, and so it's some idea, some parameters is
Yeah,
always good to kind
yeah.
of give people.
Well, so because it's a long-term focused strategy, we really try to hold as long as the market warrants it, to that momentum is there. We want to keep the momentum on our side. If we had to estimate perhaps an average holding period, something in the nature of 9 to 12 months or so would be sort of normal based on the momentum metrics that we follow longer term. And ideally, honestly, we're holding them for longer than that, because that means they're working, right? So the average turnover in a portfolio like ours is about 100% year over year. Just based on the model's history. So we are turning it over and, sort of morphing between that full risk on stance with all the sectors and something that may be slightly less than that, a little risk off positioning in those other asset classes based on the market cycle. So there is a bit of a top down input there as well. I'm sort of smiling because you say, you can look at these multiple time frames. We have in one of our weekly reports, we have a 5-day relative rotation graph that we look at, and so it's really only showing you what's happened over the last week. But even that we find valuable, not as much for the ETF, but for our sort of sense as to what is market sentiment looking like right now. Is there sort of a risk appetite, or are people positioning a bit more defensively? And of late, we've actually finally seen a bit of an unwind of the sectors that have exhibited leadership year to date. So we have, right. So what I feel is, this big rotation that you're reading about in the media, I do actually think it's pretty meaningful, at least meaningful for the next 6 months or so, in that, people were rewarding anything that was sort of technology oriented. But when we see the rotation from technology, primarily because technology, of course, has the biggest footprint in the S&P 500, really most other sectors benefit from that. So if you're giving a 12.5% position to any sector besides technology, well, then you're rewarding those sectors by an overweight position or through an overweight position. So in a market that's not solely led by technology, any kind of sort of active asset allocation and sector rotation strategy will really shine in that environment.
Yep. Well, I think just to kind of put this into perspective as well, you mentioned that TACK, the ETF, has 100% turnover year over year. Like, that's pretty impressive. Like if you were to talk to any investment advisor, they may have a 10% turnover, and then and I understand there's a difference here in kind of approaches, right? But still, that's particularly with as you call it, a longer term time from which 9 months isn't really a long term, for
It
many people.
depends
But I
on who
hear
you're
you, of
talking,
course,
right?
of course,
And I do sometimes say, well, my version of long term, right? Maybe
yes.
9+ months, right?
Yeah, yeah, and we live in the day and age of the self-directed investor, and people will come to us and say, "Hey, I like to put on longer term trades, of like a week or two,"
Yeah, there you go.
which which tells you
it's
kind of where we
it's
are,
all relative, right?
where we're at. Yeah, it's relative for sure. It also tells you a little bit where we're at. But Katie, I brought up a chart here because I want to talk a little bit about market cycles, and I'm sure this factors into your analysis. Is one of the things that we like to focus on. Can you see the chart, by the way?
I can see it.
Yeah.
Yeah.
So this is very simple, just kind of where we are. This is broader macro cyclical stories, which, I think the COVID pandemic has kind of, sunk a few wrenches into this typical cycle. But I think there's still, merits to it, particularly whether early, middle, or late cycle. Um, how do you use this, if at all, in some of your work when it comes to the rotation in the
Yeah, and
portfolios?
I think for us it's all about sort of measuring market sentiment, and you can almost do it through the sector sort of cycles, right? Or at least the perceived cycles in the sectors, right? So you'll see the rotation into the likes of the early contraction phase here, consumer staples and utilities. You'll see that rotation even week over week when folks are feeling more wary about the market, right? It's when market sentiment is getting more bearish. And it's almost, it's one of, to me, like the more reliable phenomenons out there in the market where you sense that, when investors are nervous, there is rotation into these so-called defensive sectors, right? That tend to be this kind of, associated with contraction in the economy. So it's almost like an anticipation of it. So that's what we concern ourselves with more is more the market sentiment, and it certainly relates to this cycle. And we also measure it through volatility. So we're looking at volatility metrics, things like the VIX, and that will help us understand what sentiment looks like at any given time as well. So we liken the sector rotation and the cycles to what's happening from a market sentiment perspective, and that's where I think technical analysis can add a lot of value and give a perspective, because we all know there's times at which the way the market's acting is not quite aligned with how people would expect it to, based on where we are in the economic cycle or the political cycle. So technical analysis can help you sort of fill in the blanks, right? It won't tell you why something's happening necessarily, but it will tell you what's happening. And then you can make some inferences based on that. So we also find that some of these cycles on the macro front, they are so long term, longer than 9 to 12 months. And so we need to also fill in the blanks in that regard, right? So we can have almost a full cycle of our own within that broader, longer term cycle. So because it's also fractal in a way. So we really concern ourselves mostly with market sentiment and how it's manifesting itself in that sector rotation.
Fantastic. I mean, in this day and age of, I always like to remind our clients that it's something like 85, 90% of trading nowadays is automated through some sort of algorithms or something. And so I always find there's a lot more. So we can say all we want that, let's say, for argument's sake, that we're in late expansion right now, right? Then we have to hold energy. But within that late expansion phase, which, as you say, can drag on for quarters, energy might have 3, 4 turns, that depending on how granular we want to get. Um, Before we get to one other point, I just wanted to quickly bring up this chart here, call it the quilt chart. I'm sure you're familiar with
Oh
it.
wow.
And it really talks about, sector rotation. So if you follow those, I know it's quite something. It looks like something grandma
No, very
made.
very colorful. I like
It's
it.
very colorful. Um, but it's the quilt chart, and it's really literally what we're talking about. It's what you do, it's what I do. And if you follow along those arrows, I hope you can see them. It's like I didn't make them the best color, but then again, there's so many colors that I'm not sure that any arrow would have worked. But they're orange arrows, and what I'm doing is I'm trying to show people that year over year, energy, just to pick one sector, can do really well, then do really badly, and then do really well again. So that's just the concept of rotation like that. I don't know if you have anything to say on this, but
Yeah,
I
no,
just think this is a
this is
fantastic.
like a representation of that dispersion that we were referencing earlier. You can see if we were to almost color the chart to show the grades of the declines and gains from the sectors, you'd see a pretty you'd see some dark green, and you'd also see some dark red pretty much every year. So, it does manifest itself in this way, and it makes a whole lot of sense that the driver behind it is certainly what you're identifying here, which is the economic cycle. So, we are just trying to be on the right side of that, essentially, right? To try to take advantage of these cycles through sector rotation analysis, right? Through our relative analysis, through momentum analysis. We are very comfortable, owning 8 sectors of the market in a strong tape, knowing that, a bull market, usually lifts, it's the tide that lifts all the boats, right? It usually lifts most sectors, but to kind of kick out those bottom 3, if you just look year over year, that would help your portfolio a whole lot, right?
It's huge. I mean, just look at 2020 is an anomaly, I understand, but just what the hell? Let's take that year, right? I mean, just look at the dispersion between the bottom and the top sector. You're looking consumer discretionary up 50%.
Yeah,
Energy
yeah.
down 33. The next year, energy up 56, and communication service, which was the worst, up 14. And then the following year, energy up 62, and communication down 38. And we're talking about 100%.
It's
Like
really
literally, which is
wild.
what you said before. It's
And I
incredible.
think 2022 is a good case study too for a down cycle for the market where negative returns were posted by most sectors outside of utilities and energy. And wouldn't that be a great type of environment in which to actually sort of retreat from equities entirely, right? And to pick up some other exposure that's a little more defensive, tends to outperform the S&P 500 in weaker tapes. So to have the asset allocation piece on top of the sector rotation, we feel is a great way to manage risk and to navigate those really big drawdowns. We've found that our client base on the research front, many of whom are invested in the ETF as well, a lot of them, they're later in their sort of investing career, and they cannot afford, 30% drawdown. So we try to, sort of give them ways to manage risk through the ETF and also through the research of those types of, down phases, because, once you're at the sort of end of your investing career, you really can't afford that kind of drawdown. So we focus a lot on risk management. We're actually developing a new product as well to leverage a strong technology-led tape, right? Where, a little bit higher beta exposure that could supplement a core holding like TACK in a tape that is very heavy in that sort of technology and growth outperformance.
Yep. It's literally like you knew what I was about to get through, because that's literally the next point I want to just quickly touch on before we wrap up. But this chart I think is a few months out of date. I think currently tech is now back at 30%. I mean, it depends every day, of course. But that was really my next question, and it's one thing that I've struggled with over the years. I think a lot of fund managers do. Um, you look at a sector right now, 30% tech-ish, energy, 4, 3, 8, depending on when you look at it. Historically, energy has more of a 8% average weighting, in tech closer to 20, maybe a touch lower. But I guess my question is more on the concentration of tech, and we touched on it earlier at the beginning of the discussion. From a sector rotation perspective, which is obviously what this is all about, how do you risk manage that, knowing that something is so heavy for the overall market, or in this case the S&P 500, where if that drops, then everything else kind of goes down with it, just from an
Yeah,
algorithmic perspective. I know
we've already seen
it's
that.
tough,
Yeah.
but
No, we've already seen that just recently with the pullback and how basically a crack in the likes of Nvidia really impacts the entire market. So that there is that issue that we have to navigate. I think to have sort of equal weighted positions on the sector front, or even equal weighted positions on the stock level, is one way to spread out and leverage an environment that has strong breadth but perhaps narrow leadership, because you can take a portfolio like that. I think about the S&P 500 equal weighted ETF, or something of that nature, or even something that has more small and mid cap stocks like a Russell 2000 ETF. You can take those and basically supplement them with technology stock exposure when tech stocks are exhibiting leadership. What I found is among our clients, they mostly ask about technology stocks. So, and they probably know the most about these technology stocks, right? So I actually feel like that's not too hard for most of the people I talk to say, okay, well, I'm going to have these core holdings that are long term. I can kind of set it and forget it. I don't need to worry about those. And then around that core holding, whatever it is, you can build on that technology exposure and be a little bit more opportunistic, right, in the way you're approaching it, and a little bit shorter term as well, more sensitive perhaps to loss of momentum. I always say, a very simple technical tool to apply to like a high flying technology stock like an Nvidia. You could take the 20-day moving average and simply, when it starts to roll over, well, it's usually an okay time to, at least reduce partial exposure. It's very simple. It's basically, trend following 101. But I think to have some kind of supplemental technology exposure during a strong tape is really the way to go. And honestly, I think investors will sort of enjoy that, because they really enjoy trading technology stocks. They want to buy Snowflake, and they want to understand, what Salesforce's earnings are going to look like. I get a lot more questions about those type of companies than I do about, Caterpillar and Deere.
no doubt we see the same exact thing.
Hmm.
Well, Katie, this has been a real pleasure. I really appreciate your insight, and I hope for everyone listening or watching this, this was helpful to you too. Again, Katie Stockton, people can find out more about you and your work. It's Fairlead Strategies is the research, and then the TACK ETF, the ticker symbol is TACK.
That's
Find out
right.
more about that.
Thank you, Serge. Yeah, it's been
Thank you
great
so
talking
much.
to you.